All right. Hello, everybody. Welcome back to another episode of the Market Close. It is Monday, December 30th, 3:45 p.m. And we've got a little bit of a reversal that is happening in the equity markets from what we saw this morning. It's not a full reversal. It's not like we went green, but we definitely aren't as red as we were at the market open, which is nice to see. And we're going to talk about today why that's happening, how I think the market's kind of interpreting some of the downside weakness that we saw today, and what that means ultimately going into the future for 2025. Now, one thing that we will be doing at about 4:05 p.m., so in about 20 minutes, is I will be live on a Twitter Spaces with two people, Evan and Wolf Financial, big financial people on Twitter, and then Stephanie Guild, who is the Robinhood head of investment strategy, kind of like how Liz Young is for SoFi. Robinhood has Stephanie Guild. So I'll be live with her at 4:05. That'll go until 4:30. So it'll be about 25 minutes. And I think it'll be good because we'll get someone who's been in equity markets for the past 3 decades, get their thoughts on what's happening in 2025, their outlook, where they think the market's ultimately going. And then after that, we'll finish off with the regular market close probably by 5 p.m. So 4 p.m. we'll get on live with her. We'll hear her thoughts for the next 30 minutes from 4 to 30. I think she has a hard stop at 4:30. And then 4:30 to 5, we will end out the show normally on the market close as usual. All right, cool stuff. So we'll be getting into that in about 20 minutes. Until then, let's take a look at how these markets kind of reversed, if you want to call it that. We've got a lot of outliers here. So first of all, let's start with Bitcoin. Amazing reversal on Bitcoin. 91,291 is where we bottomed today. Now we're at 94,335. This is very impressive strength, and it kind of makes me feel like the downside that we saw this morning, down about 3-4%, that was either based on low volume, maybe some manipulation, some leverage longs kind of getting wiped out as market makers tend to do, and then Bitcoin kind of comes back up. I think over the weekend, there was $900 million of leverage longs that got wiped out. Like, this is just a game that is very tough, and there's a lot of external factors. The only way to really beat the game, quite frankly, is to go long if you believe in the asset class. But 91 to 94 is a hell of a rebound, and that helped MSTR, which was at one point very close to going below 300. Now it's at 311, still down 6% of the day. MicroStrategy did buy another $200 million worth of Bitcoin, but it's not as bad as it was in the morning, which is nice. You have Coinbase right here. That is still down 3% of the day, but it was at 247. Now it's at 255. Robinhood got a little bit of a bump. Robinhood never really got too low. It was down, I think, 3% the most on the day. Now it's down 1.5% at 38.42. And so overall, the Bitcoin rebound definitely helped. Now, outside of Bitcoin, we also have the Mag 7. The only one that looks like it's going to end green on the day is NVIDIA at 138.50. We do have an NVIDIA update that we're going to talk about in a second. It's pretty big news for NVIDIA, and I'm very curious from a political standpoint how they're going to be able to navigate it. But even the rest of these names, Apple was down 2%, now it's down 1%. Meta was down 4%, now it's down 1%. Microsoft was down 2%, now it's down 1%. Google, barely down, 0.3%. Tesla, one point Tesla was getting close to 405, now it's at 420. Nice little rebound. Amazon right here, 222. That's down 0.65%. And then NVIDIA up 1% on the day. So the point is, if you bought the dip this morning, I mean, you can't be that upset because so far it's reversed and it's gone really well. There are some people saying this is a bull trap. Maybe they're right. Maybe they're wrong. We're going to see. We'll get pretty soon into 2025 and kind of see how the markets are interpreting it. In general, I am pretty bullish for 2025. I do think there will be volatility to get there. But if you took advantage of some dips this morning, you are definitely not too upset at buying those dips. Now, Faraday Future has been the safe haven today, 74% on the day. Don't ask me why that's happening. I have no idea. If someone in the chat has an explanation, I would love to hear your explanation over mine. But that pales in comparison to Micro Cloud Hologram Incorporated, which is up 175% today. So, I mean, like, I don't know how to explain that. I don't know how to explain Tesla being down 3%, but Micro Cloud Hologram being up 175%. I still don't know what these guys do. I'm going to have to look it up a little later. And they were at 780 at one point. Right now, they're at 662. But you do have pockets of the market that did outperform, even though the rest of the market ended up reversing. Faraday Future right here up 74%. GameStop's actually flat on the day. It was up about 2%. NVIDIA up 1%. Rumble still down 9%. It was down about 15%. So Rumble, a little bit of recovery. And then TLT slightly up as bond yields have slightly come down. Now, the major indices, what's going on with them? S&P 500, it was down 2%. Now it's down 0.88%. Not a bad reversal, not a full reversal, but not a bad move to the upside as we have a V-shaped recovery in the broader indices. The Qs were down 2.2%. Now they're down 1.03%. That's not bad. And then you have small caps that were down 2.4%. They're down 0.47% now. It's kind of undeniable. We had a little bit of a reversal where maybe Santa Claus actually came to town towards the end of the day or before New Year's Eve. And hopefully next year or tomorrow, if New Year's Eve is not too bad, we end up to be pretty green. Now, here's another thing that's helping equity markets do well. Look at the 10-year. It's actually coming down a decent amount today. It was at 4.625 last night at 8:25 p.m. Today, as we get into the close, it's at 4.549. It's not like it's coming down dramatically, but it's coming down enough for equities to breathe a little bit. If you look at the CNN Fear and Greed Index, we're still at 29 on fear. That hasn't changed yet. So for those that did buy the dip, it's not the worst thing in the world. It's just a question of how much more volatility do we have to take before things get a little bit more aggressive to the downside, because we really haven't seen aggression towards the downside outside of the 3.5% J-Pow presser sell-off that we had, which then reversed on Christmas Eve. So not bad. Not bad at all. Magic says your boy Meet Kevin has gone full FUD mode. I haven't got Meet Kevin's updates yet. I would imagine that given the volatility we're experiencing, given the 10-year, given tariffs, given all this different stuff, one would make a bearish thesis, especially if they've been bearish all year. They might finally think, okay, all the signs are coming together to be full on bearish. I just don't subscribe to that point of view. I think here's how I could turn bearish. Earnings growth has to fall off a cliff. That's there's going to be very transparent. If earnings growth falls off a cliff, I'll get bearish. I don't think that's happening. Not from the data that I've seen, not from the analysis that I've read on these companies. I mean, let's transition into video. This kind of proves my point for why it's hard to be bearish on the market with all this technology, which translates into earnings growth. NVIDIA is going to get $7 billion of revenue. $7 billion with a B from ByteDance next year, the company that owns TikTok. So the information reports today, ByteDance continues to use NVIDIA's most advanced artificial intelligence chips despite U.S. efforts to block Chinese companies from using them. The Chinese owner of TikTok recently told suppliers it plans to spend up to $7 billion in 2025. This is not a continuation from 2024 purchase orders. These are new purchase orders for 2025, $7 billion from one company. Last quarter, NVIDIA did $34 billion in revenue. So, I mean, $7 billion is not a small amount given they did $34 billion in revenue in the whole quarter last year. This is from one company, and this would be from ByteDance to improve their artificial intelligence models on popular products that they have. TikTok is the biggest product that all of us know, but ByteDance has lots of different products. ByteDance is worth about $250 billion, so it makes sense for them to stay competitive with the rest of the Chinese market and get these chips. Now, is the United States going to let NVIDIA sell $7 billion of chips to ByteDance? I don't know. And that's why I'm saying from a political perspective, I don't even know if that deal goes through. But if Trump is getting a bit more friendlier to growth and Trump's actually a fan of TikTok, which is another question, like if TikTok gets banned in the United States, which we're going to know in a couple weeks based on what the Supreme Court says, January 19th, will ByteDance have the need to buy $7 billion worth of NVIDIA GPUs, right? So these are the questions that are looming around this. But let's just say it goes through. Let's just say they're going to buy $7 billion of NVIDIA chips. I don't get how someone can be bearish about that. And that's why I'm not bearish. It's very difficult to be bearish when you have that level of earnings growth that we know is going to affect NVIDIA's bottom line and that we know and we can see that the signs are coming. So look, could you get bearish because of the 10-year? Yes. Could you get bearish because of a potential recession due to employee layoffs if the unemployment rate is rising? Yes. Could you get bearish because of interest rates? Yes. Could you get bearish because of tariffs? Yes. But what I just said in that paragraph of all these different reasons you could get bearish, that has been true for the past 100 years. You can always find a reason to get bearish. There are very few times where you are definitively right, aka 2008 or 2022. And the amount of people that get those opportunities right is just like, it's 1 in a million, right? 1 in a billion, quite frankly. That's why Michael Burry's so special. That's why a lot of people still respect him, because he got it right. But he's been trying to get it right for the past 10 years every time, and he's not gotten it right after. So that is why I'm generally more bullish, and I think the markets can still do well next year. So this is another headline we have. U.S. Treasury says documents were stolen by Chinese hackers in a major incident. That did happen today as well, which was not good. I don't really understand the implications of this, to be honest. I know it did happen. The implications to me is CrowdStrike and all these other companies should get a little bit of a tailwind if that much. If the U.S. Department of Defense and the overall Treasury is not able to hold on to their documents as correctly. We also saw this today with Ford. This was not the best thing in the world as well. You got a whole lot of random stuff going on, which just begs the need for more cybersecurity as an industry. Ford was hacked, and they had some political tweets, as you guys can see on the screen right here. How did this happen? Who knows? But the fact that Ford, like, I know Ford doesn't like innovative technology. I get it. I understand Ford is like afraid of innovative tech, but two-factor authentication shouldn't be the most scary thing to embrace when it comes to innovative technology. So I don't know, but we were definitely seeing a bunch of random things happen in the broader equity markets and based on different companies that have had things hacked. And by the way, Ford's not the only one. Last week, Vinod Khosla, who is a major VC at Khosla Ventures, he had his Twitter hacked, and people in whoever hacked his Twitter was shilling some meme coin with his Solana address. So random stuff is happening. I think that only shows that cybersecurity is going to be more important and probably will be more relevant over the next coming years. Let's get an update on Microsoft and the amount of CapEx they're spending on AI, because we do have some updates on that. And then in about 10 minutes, we will get live with Stephanie Guild from Robinhood.
Biggest factors weighing on Microsoft. Hi, Steve.
Hey, Mike. It's capital expenditures, of course, and Microsoft ending 2024 spending at least $53 billion on CapEx. Nearly all of that for AI infrastructure, and that's before we get to the $20 billion expected to be spent this quarter alone. Microsoft implied to expect around $20 billion in these capital expenditures each quarter going in 2025. The risk: investors losing their patience for a return on this massive spending. CEO Satya Nadella and CFO Amy Hood on recent earnings calls said the AI demand is there and Microsoft will keep spending to meet it. In the meantime, though, don't have a clear view of how well Microsoft's suite of AI products are selling. Microsoft has said it's on track to generate $10 billion worth of AI-related sales this year, but a lot of that is coming from the Azure cloud business. As for the rest of the AI stuff, Copilot Plus PCs, they launched this year, but without the marquee AI feature called Recall. Also, no clue how well Copilot for businesses is selling after more than a year on the market. I've also heard a few CTOs say 2025 will be the year they assess.
This is a big deal, because in 2025, you're going to have CFOs go up to their CTOs and try to figure out, hey, like, should we be paying for Copilot or not? Are we getting an ROI? And right now, as you can see on this chart right here, CEOs don't know if it's justified or not. If it's not justified by the end of 2025, that means most of Microsoft's AI revenue is going to be cloud. As you can see, he said right there, they spent $70 billion on CapEx. They made $10 billion in AI revenues, but a majority of those AI revenues were cloud. That needs to become Copilot next year. And if that doesn't happen, that might be an issue for the overall CapEx story that Microsoft has right now.
If Copilot is worth that enormous cost. And then there's OpenAI. Its losses are now bleeding over to Microsoft, its biggest benefactor. Microsoft said it expects OpenAI's losses to shave a couple cents off its EPS in the December quarter. Mike, that would be about $1.5 billion.
Yeah, and worth noting, of course, Microsoft stock's been kind of sideways for.
And Microsoft has been sideways for that reason, that investors are just not sure if the AI CapEx that they're spending is going to result in anything meaningful in terms of ROI. Another stat that's important to understand if you own Microsoft stock, they announced a couple of days ago, or it might have been a couple weeks ago, but OpenAI is going to result in a couple cents of losses on their overall EPS because they own equity in OpenAI. OpenAI is losing a couple $2 billion this year, so they have to report those as like markdown losses on the equity investments that they hold. So Microsoft will lose a couple cents. It's not going to be that big of a deal. But the point is, like, OpenAI right now is more of a headwind for them in terms of their earnings results versus the tailwind that they thought it would be. Now, long term, they believe OpenAI is going to work out. But as of now, definitely they are, hoping the long term wins against the short term. So that's going to be important. And it's not just going to affect Microsoft. It's going to affect Amazon, Google, Meta. Meta's, I think, the ones that's shown the most promise right now with their advertising in regards to how they're utilizing these NVIDIA GPUs. But there's going to be a lot of questions in 2025 on the Max 7. Can they increase earnings growth? I think they will. But again, market's going to have to see it. Market's really going to have to see if that earnings growth is going to live up to these valuations that we have right now. NVIDIA looks like it's going to close up about 0.34%. We got the close in about 20 seconds. Everything will close red today. It's just not going to be as red as it was at 9:30, which is nice. But nonetheless, we will definitely get a red close here as we get into 4 p.m. All right, here we go. Monday, December 30th, 4 p.m. The stock market is now closed. right. Markets are closed in 5 minutes. I'll be hopping onto a Twitter Spaces with Stephanie Guild, the head of investment strategies at Robinhood's. I'll be streaming that live here as well. But let's take a look at how the markets ended today, second to last day of 2024 for the stock market. S&P 500 down about 1.13%. The Qs down 1.3%. IWM down about 0.77%. They all got a little bit more of some downside right into the close. I mean, they were up a little bit at 350, then by 357, they all got a bit more red. So we did get a little bit of a sell-off towards the end of the day. Archer Aviation down 10%. MicroStrategy, wow, down 8%. Holy crap. Do you guys see this red candle? I didn't even see that. When I started the show at 3:45, we were at 3:14. We ended at 3:02. So someone just dumped a crap ton of MicroStrategy right at the end of the day. Tesla goes down about 3.3%. ASTS was down 4% of the day. Grab was down about 1%. Palantir held up pretty nicely, down 2.4%. We couldn't close above 79, but 77.18 is not the worst thing for Palantir. GameStop right here, down about 0.68%. NVIDIA, again, up 0.3%. TLT was up a little bit today, up about 1%. Nike was down 2.28% today. By the way, Bill Ackman came out and he had one of his Bill Ackman tweets where he just writes an essay. And he's pitching Fannie Mae and Freddie Mac common stock as one of the biggest asymmetric beneficiaries of the new Trump administration. Now, you cannot buy this name on a regular exchange. Correct me if I'm wrong, but this is an OTC name. And this is a long post. You guys can read it if you want. But Ackman basically says, hey, if Trump actually reduces regulations, then Fannie Mae and Freddie Mac should do a lot better going into next year. The ticker symbol is FNMA, but you can't buy it on a regular exchange. You have to do that on the OTC markets. So he said he'll be doing a video later explaining his thesis. But it's really tied to Trump and deregulation. Schlumberger, that was flat on the day. Grinder, up 1.76%. I mean, it is what it is, dude. CleanSpark right here, down about 2.7%. Marathon was down 6%. Wow, I didn't even know Marathon dumped into the end of the close as well. Hims was down 5%. Celsius was down 3%. Oscar Health was down 1.6%. Rocket Lab was down 10%, so it only ended down 3%, which is very nice. We got a nice reversal there. Nubank, great day for Nubank, up 3%, one of the winners today. And then AMD, down 2.2%. They were upgraded to $175 by Northland. AMD was down 2% today, along with the rest of the semiconductor sector. NVIDIA was the only one that actually ended green on the day. SoFi right here down 2% as well. And then Robinhood, we ended the day down 1.9% at $38.28. There we go. That's what we've got in terms of how the markets ended up closing for today. Okay, cool. So let me hop on to Twitter Spaces. So we're going to be talking to Stephanie Guild. I think that Twitter Spaces is starting right now. And we will get her thoughts on what's going on in the markets. Are they live? All right, they're live. All right, so guys, here's what I'm going to do. I'm going to share the spaces on the computer because I don't want the audio to be crappy. So I'm going to share it on the computer. I'm going to mute myself here. I'll still be in the chat, so I'll be talking in the chat the whole time. And this will be about 30 minutes. It'll be done by 4:30, but this is the head of investment strategy at Robinhood. We'll get her thoughts for 2025, and then we will keep going from there. All right, here we go.
After those 2+ decades, I felt like, I don't know, I wanted to do more. I felt like there was more to be done, and Robinhood was certainly a place that was doing things differently. And so I joined Robinhood about 3 years ago as head of investment strategy. And I during this time, I feel like I have 2 roles at the company. The first is just having a macro and set of micro views to share with our customer base, and hopefully have it helping them learn along the way. And then the second is helping to build products and providing my experience and fuse that into the products that we've been delivering over the last couple of years. Other than that, I live in New York and have 2 kids and also have my CFA.
I love it. I love it. A person of many talents, skills, and experiences. Okay, well, let's go ahead and get started then here today. As I mentioned, we're going to do this a little bit Q&A style, and I've got a couple co-hosts up here who can work in as they'd like. Feel free to throw up a hand when either of you co-hosts do want to jump in. I'd like to start off with this thread that you wrote, which outlines really what you believe the markets will look like in 2025. And it starts from the top with a overview of the economy. And it'd be great if you could start there explaining your thoughts for 2025, starting with the economy, flowing into interest rates.
Yeah, sure. So I see the title of my article. So I write something called Investors Guild. It comes out once a week. I took a break last week and this week, but I come out to try to write about different things that are happening in the market. But this one in particular was about the 2025, my 2025 outlook, and it was entitled "It's Always and Never Different." And the reason why I wrote it that way is because I do see some things that are different this time around, and I'll get to that in a second. But things are not, usually never completely different, I should say. And so I see the economy kind of got to this soft landing status this year, and one of the reasons why this is, by the way, the fourth ever since 1960. And the ingredients that usually have to happen is that the Fed stops raising rates and then they start to reverse it, which they've done so far this year. Another ingredient is usually that something distinct is that there is an allowance of capex growth, and costs are, margins are allowed to be for a company's balance sheet, and income statement. Margins are allowed to be a little thinner than they've been in the past, and that aspect means that the labor market is kind of, upheld. Customer or companies are allowing their costs to be a little higher, and we've actually seen, for the last couple of years, you've seen sales growth growing at a much lower pace than capex growth. And why is this important? Because that ends up meaning that the companies are investing in their own research, in their own product development, in their people, and it really just tends to create this knock-on effect of growth in the economy. And we saw it again, as I said, in the 1960s, the 1980s, and the 1990s when we had the last three of them. And so this time we're seeing it the same. And that's why I think we'll have GDP growth that is above, the kind of post global financial crisis world. I really think things shifted in 2008, and I think they're kind of shifting back. And so that's why I think we'll actually have real GDP growth of 3%, which is definitely on the higher end of a lot of economists out there, but is the average of the last 6 months. And we saw this pretty consistently pre global financial crisis. We saw GDP growth of 3% or even higher in parts. And so I think unemployment will stay around where it is today, 4.2%. I can get into later about tons of risks that, can be thought of in my outlook. And one of them being that if, that margin compression is not allowed to stay anymore and companies start cutting labor. But that's not my base case. And because of this, I think that interest rates, because of the growth that we'll have, interest rates will likely stay on the higher end. This came out in the last Fed meeting, but I expect that progress will stall, and we've already seen that. So when I wrote that, I was kind of like, it wasn't, a crazy assumption, but interestingly, like consensus was that inflation would be lower at the end of the year than even what the Fed said on December 18th. And so I think I always thought, and the Fed came toward me in this last expectation that they would stop cutting at 4%. And I think the 10-year treasury yield, which is extremely important for broad market valuations, would likely stay elevated. And I do think there are risks for it to go higher. And that comes back to our deficit and just kind of having to deal with the fact that our federal government has so much debt on its balance sheet. But that also means that it's unlikely, I think, to see mortgage rates come down a lot, credit card rates, like the things that we use every day. And that's the downside of strong growth, I think.
Very interesting expectations. And I did, while you were speaking there, pin that thread up top so people can see a little bit more detail
Mm.
and the numbers that you're specifically referencing. And I encourage people, go and engage with that. If you do have questions, you can comment them on there as well. So you can look through some of the details here. And it really does outline your expectations One of the things that stood out to me in this was you said, to quote here, and third, I expect earnings and stocks to move higher in 2025, but it's different this time. I expect the S&P to reach 6,500, up 7% in 2025, but I also expect mid caps and small caps to post double digit returns of 20% plus. So I have greater confidence in mid cap returns. So you seem to be kind of leaning towards that mid cap area. Is that mainly due to that margin compression that you were speaking to there, combined with the rates?
Yeah, I'd say it's partly the margin compression, and two other things. One I didn't even mention in my article, but one is down to interest rates being elevated, and small caps tend to have more leverage on their balance sheets on average, right? That doesn't mean that you can't find a good small cap stock that will defy that, but in general, if we're looking at just like broad market, I just think mid caps are in better shape to withstand a higher interest rate environment. Small caps tend to have 27% more leverage than large caps on their balance sheet, whereas mid caps tend to have only about 7% more. So, give or take, it's about the same. But my expectations for higher returns in those areas, I think, come back to also the fact that like someone has argued with me in the past that if you have higher interest rates, and how can you expect something like small caps to do better if they have higher leverage? But I kind of believe in the earnings growth story of the small and mid cap space. Earnings growth are expected to grow at double digits for the next 2 years. And I like to look at 2026. I think 2025, um, I think the market actually looks sometimes beyond even the next 12 months. And so if you believe that earnings growth will actually be the same or better than large caps, so mid cap stocks and small cap stocks are expected to have earnings growth in 2026 of 12% and 31% in 2026, as I said. So S&P broadly is only supposed to have earnings growth of 13%. So if you have same or better earnings growth, but much better valuations, like mid caps are valued at 16 and a half times if you're looking at 2026 earnings, and small caps are valued at 20 times. So if you and S&P is valued at 20 times. But historically speaking, if you take out the year 2020 and you go back and look at like where valuations have been in the small and mid cap space, for mid caps they're about 3 turns lower than they are on average, or even in a median space. Small caps are even cheaper than that. It's about 7 times cheaper than they tend to be, historically speaking. So if you have good earnings growth that are double digit and you have cheap valuations, like that to me will overcome potentially some headwinds that could come from higher interest rates. I mean, if we have higher interest rates across the board that are much higher than expected, then that movement is going to probably impact the whole market. The last piece that I didn't even mention in my article is that the reason why I'm biased toward mid caps is because of leverage, but also because I feel like they're the middle children. Like they're not the oldest and they're not the weakest, and they can just, I feel like they get forgotten about. And these are the mid cap stocks that end up moving into the S&P, and some of the strongest ones like we've seen this past year. So that's my sort of view.
Very well put. I have a couple more thoughts here, but I want to check. Evan, do you have any thoughts or questions you want to throw in here?
Yeah, Stephanie, I appreciate you doing this interview with us. And if you guys are not already following her and Wolf and Ahmed, obviously, you are totally missing out. Appreciate you being here. I wanted to ask kind of about like, obviously, there is one trading day left now in this year, and tax loss harvesting and all that stuff has been a conversation. There's a lot of stuff that goes on around end of the year and start of next year and the start of a new year, early January. I want to get your thoughts around kind of just the general market conditions over this next couple days and weeks.
Yeah, it's a good question. I think kind of a common prediction is that we're not going to have. If you said a week ago, people said, "Oh, you're probably going to see the markets go sideways. Maybe we'll get a Santa Claus rally, and that January you might see some selling because no one wants to take gains this year. They want to wait to take those gains until next year." But generally speaking, I think you've seen the market kind of soft in the last week or so. So I think that is starting. People are starting. I mean, we have very low volume, so you usually can't guess the market direction just based on this week because everybody's on vacation. It was a good year, but I I think you're starting to see some people take some profits this week, and that's why you have a little bit of a softer market. you could see that come in even higher volumes in January. But I still have a positive view, and so any right now, just based on my overall like economic and market view, if we did have a sell-off sometime in early January, I wouldn't be surprised if that sort of started to reverse after that. And so, it might not be a bad time if you have extra cash to put to work to use it as an opportunity.
Amit, I saw your hand going up there.
Yeah. Hey, Stephanie. First of all, thank you for doing this with
Hey.
us. We are definitely big fans of your content and everything you're doing at Robinhood. My question is about this debate that I think the market's struggling with right now, which is obviously large caps are expensive and they are definitely extended. But I don't know if people really want to go to sleep at night investing in small caps versus a brand they know like Amazon or Facebook. So, what is your kind of thoughts on the ideas that winners might keep winning even if valuations do get insane versus a rotation from those winners because people just might not feel safe enough to invest in something like mid caps or small caps?
Yeah, it's a really good question. I think you always have to invest based on, your ability and willingness to take risk. And if you don't feel comfortable allocating to small caps, you shouldn't do it. But my view is more that I think small caps and mid caps have not been overly invested. And so my call isn't to move to say take all of your allocations and your large cap mainstay stocks and move it into small and mid cap. It was much more to say like this is a place of opportunity, and it may be a place that if it's the right for you and right for your risk level to allocate some dollars there because there could be better returns, and it might be a better, it might give you a better overall mix than just keeping some of the largest cap tech names. And if you look back, also, I would say in the first year or two of Trump's administration, mid and small caps did do better until they cut corporate tax rates, and then large caps started outperforming again. Mostly, I think because the large caps did, had a more of a benefit from those corporate tax cuts. But I also would say that I I think, and something we didn't cover yet from my outlook is that I think we've been and we are in and have been for at least the second half of this year in an environment where doing research on single names and really like looking at company management and the decisions they make um, are going to be more rewarding than they had been in the whole post global financial crisis era. And so even if you're like, I don't want to get rid of my Amazon because I think it's going to continue to do well. I don't want to get rid of my Tesla because I think it's going to do well. It's just that you might want to broaden your view because actually doing the work, I think, is going to pay off more so than it had, when interest rates were zero and risk didn't cost a lot to take. Like back then, you just needed to be invested. Like I think post 2008, you just needed to be invested, and S&P was a great place to put your money. But I think, in this environment, like it it's forcing company management to make decisions that will affect the trajectory of the company and its earnings growth. And so, especially with a higher interest rate environment, it forces financial discipline. And that's why I think like, you just want to make sure you're not turning over that rock and considering it.
Great question. I am going to propel us a little bit forward here to a big topic, which I've been looking forward to hearing from you on, and that's Robinhood customer activity and what you can tell us, maybe trends from 2024 and what you're looking for in 2025.
Yeah, I think I have a great respect for our customer base, broadly speaking, when I watch the way that they navigate the market. 2022 was not a great year for the markets, and we saw that our customer base did not really materially change their positioning. At the top of, we have something called the Robinhood Investor Index. We watch it on a monthly basis. We rebalance it on a monthly basis, and that consistently has had Tesla, other electric vehicle names, and then a lot of the large cap tech names in it ranked at the top. And that 2022's price action in the market didn't sway our customer base. And this year, I would say what I've seen even more so is these core positions remain core positions. And I'm making a generalization, but they remain core positions for our customer base. And then they trade around the volatility. So the majority of their positioning has not materially changed in that they hold on to the large cap tech names like Amazon and Apple, Microsoft. Excuse me, and then when they go down, they buy a little more, and when they go up a lot, they trim. They don't necessarily outright sell. So we've seen that a lot. I would say also that we had those election contracts in November. And you saw from the trading around the election that our customer base certainly knew who was going to win the election before the major networks did. And you've seen in our Robinhood Investor Index, the performance of our customer base really caught up to the broad based indices in the month of November and has actually continued that trajectory and now should end the year outperforming the broad based indices, mostly because of some of the position, the obviously Tesla has done extremely well in the fourth quarter. Um, and a lot of the other positions that they have had. I would also say like companies like MicroStrategy have become more popular in positioning. And I do think that our customer base, because they are younger on average, right? The median age is 34. That is probably 2 decades below some of the other competitors. That they invest for the long term, and I think they use that to their ability. Um, I know Palantir has also been a very popular name that has moved up in the rankings over the period. The other last point. The other aspect that I've also seen is much more use of broad-based index funds. Also in the parts when or the times when the market dips. So it's not always just the names that they own, but also just broad-based participation. When there is a market dip, especially.
Really interesting insights, and yes, definitely, it's cool to see what's popular among retail investors. Did you
They're
have
really
any
smart,
the
I think.
smartest?
Yeah.
Amit, did you have any thoughts or questions off that?
Yeah, I think, it's really cool what Robinhood has done. I mean, I think the company is empowering retail investors. The type of information and crowdsourcing of due diligence, all of this stuff is just accessible with today's technology. And I think Robinhood's really trying to push that forward and give retail investors an edge. Another kind of question piggybacking off retail investors, Stephanie, is do you think retail investors at all are interested in the fixed income markets, the bond markets, the treasury markets? Money market funds, or are you seeing more activity geared towards equities? And what implications do you think that has going into next year?
Certainly a generalization I'm about to say, but I don't see a lot of demand for bonds in the traditional sense. We certainly saw a ton of interest in our our high yielding cash product. If you're a gold customer, a lot of customers parked cash there to participate in that, and obviously our rate was a lot higher than you could get at most banks. Um, and there is some in the T-bill, interest in the T-bill area, but other than that, I wouldn't say that bonds tends to be a demand of our customer base. And again, it might just come back to the age of our customer base. When I'm older, I probably think more about keeping my money a little more stable and maybe owning bonds. Although honestly, bonds haven't been that stable. They had a bad year this year. They had a bad year last year. I think 2022 was one of the worst years in the broad bond market. So, I think if I'm an investor and I started investing in the last couple of years and looked at the bond market, I would have thought, well, why would I even bother participating in that? So I don't see a big use for it, but I think the time will come. You'll have at some point you will have a recession. I'm sure they tend to come every 7-ish years, um, and that's usually when bonds will be a better place to hide until you get towards the end of the recession, but it hasn't been the case this time. And I think it's just because we're transitioning out of this post global financial crisis mode, and interest rates have had to move higher after being artificially kept at zero for a huge amount of time, unprecedented.
Stephanie, I'd love to talk about if there's any like risks out there that you are most concerned about from the market, whether it's like the economy or maybe a little bit more like micro specific. I'm curious kind of what concerns you have possibly going into the market in 2025.
Yeah, um I'd say one is just I said this before, but I think there are three main things that come into investing. If you're thinking long term, this is certainly doesn't necessarily apply if you're just doing a short term trade. But it's the direction of interest rates, um, earnings growth, and sentiment. And so let me address sentiment for a second. I kind of mentioned this before, but uh, this time last year, I looked at 14 major financial institutions, and they had the median expected return was 4% for 2024. Obviously, we blew that away, and they spent the rest of the year playing catch up. This year, the median return is 8.5%, and there's a range even up to seven, S&P getting to 7,000. And if I've been going on CNBC and Bloomberg, and every other person around me, every other strategist around me is like small caps, small caps, small caps, and it just makes me nervous. Like whenever there is high expectations, like I liken this as like when someone tells you to go see a movie that they love and they think it's the funniest movie ever, and then you go see it and you're like that was funny, but you don't your expectations were too high, and that's what I worry about for this market this year, especially at the back of the election, and I think the movement upward has built in a lot of expectation of deregulation and potentially tax cuts, and just a lot of things that obviously are helpful for the market and can be helpful for the economy. But once they make it into the price, then there's more room for error. The second just being the interest rates, right? The direction of interest rates has been moving within a range, but certainly there's risk for it to move higher. Our deficit is 1.9 trillion, and expected to grow. And the biggest government spending is Social Security, Medicare, and Medicaid. And until we won't deal with that, I think it's going to end up being like arguing over very small pieces, and we probably need to make some harder decisions as a country. But that to me is a risk, right? Because now I think we spend $1 trillion on interest alone. And so when you have more and more debt coming and interest costs, like the bond vigilantes, which was coined in the 80s, when interest rates were really high. So our interest costs as a percent of GDP was very high back then, but not as much about the deficit, but more about just the cost. Interest rates were double digits back then. That's when it starts. The bond vigilantes could come out and say, look, if you want to take us to let you borrow this much, federal government, then it's going to cost you more to do that. So that's like a risk, because if interest rates start to get well above 5%, then valuations I think have to move to take that into account. And then on the upside, I'd say some of the pieces of my base case, inflation, that obviously it's been lowered, but it's still a risk. Like, if we have good growth, like I said before, if I do expect good growth, like inflation is something you just have to continue to watch. And also what I said before, which is, company cost cutting could increase to start to protect their margins. And, on average, labor is 70% of an employer's costs. And so that is often a place where, if we start to see that happen, then you could see unemployment start to rise, and that could lower growth. We'll just have to see, because the other side of that obviously is AI, and is it just one of those times in history where unemployment does go a bit higher, but productivity actually improves at the same time. And maybe that's still good for an investor, but not necessarily good for the everyday person. And then what do we do about that? So those are just some things on my mind.
Great question and answer there from both sides. So one of the other things, of course, is that we're pretty much at the end of the year here. And so there are a couple things that'd be helpful for people to understand: tax loss harvesting, gifting gains, backdoor Roth. Feels like this would be a great time to cover it, and any insights and information you can impart to the audience that would help them with these items.
Yeah, you have 1 day left to go and do some of the year end maintenance that I always like to do. I used to do for my customers, and you know, would love to impart on the audience. So tax loss harvesting. While we have gains this year, I was looking at it. It was close to around 300 names in the Russell 1000 index, so the largest 1,000 companies that still had a negative return this year. So despite the bull market, you still had those companies that just in a not hitting very well. And so those are the places that if you sell, if you have gains elsewhere, and you have losses in something else, you can sell both of them, and then that will neutralize your tax impact. And just you want to make sure you didn't trade the stock, either the stock that you're taking the loss in 30 days before or 30 days after. And then once that time period is clear, then you can always go back and buy it if you still want to be an owner of it. Charitable giving, it's another way if you do have tax gains this year or just want to look to offset some income. One of the most efficient ways to give to charity is actually to send shares directly to the charity, but make sure they're shares that have a gain in them and that you've held them for at least a year. Because the caveat to is if you send shares that you have held for less than a year that have a gain, you only get the deduction only is at the cost basis. It's only the cost, not the full gain. So you want to make sure that you gift shares that are appreciated and you've held them for more than a year. Then you get the full deduction. You don't have to pay taxes on basically the sale that the charity ends up doing of those shares, and then you can turn right around and buy those shares again if you want to keep them in your portfolio. So it's a really I think efficient way to give to charity. But as I said, you only have 1 day left. FSA funds, just deal with that. And then, backdoor Roth, like if you want to keep it all in the same tax year, backdoor Roth is if you're over the income limit of giving to a Roth, you can transfer cash into a traditional IRA and then immediately transfer it to a Roth IRA. And you just want to make sure that you're putting that tradition. One thing a caveat you want to be aware of is if you already have a traditional IRA that has pre-tax money. So let's say you had a 401k somewhere, you rolled it into an IRA. Those funds have never been taxed. So if you do this backdoor Roth thing, the IRS will still say you owe some taxes. It's called the pro rata rule, and it will be based on the total dollars you have pre-tax and how many dollars you moved into the Roth. So I'm definitely not an accountant. Definitely go talk to an accountant or look this up on the IRS website. But if you don't have any pre-tax funds in an IRA, I think it's a great way to get money into Roth. And the benefit of a Roth is that you never pay taxes on it again. Any gains, are tax free, assuming that you have the money in there for 5 years, and you're over 59 and a half when you take the money out.
Yeah, fully agree. The Roth is a beautiful instrument. It feels like anything that the government limits you putting money into, there may be some benefits there.
It's a good way to put it.
Absolutely. Okay, really, really good conversation, running through a bunch of things. Wanted to check in once more with my co-host, see what other questions they had in general around the market or potentially any of these end of year items. Evan, any thoughts coming to mind for yourself?
No, nothing much more else for me. First of all, I do want to say everyone should make sure they're following Stephanie, as I did
Aw,
say
thank you.
earlier. I am very curious in some of these names that have underperformed this year on how they're going to end up. Like the names, like even I know we've talked. I think you said like 300 something in the Russell 3000 or 2000. Um, but when I look at some of these larger names, there's an AMD, there's an Intel, there's a couple names that have struggled this year, and I am very curious on what they do at the start of next year. I'm curious if you have any thoughts on those type of names. There's a couple of them, not many with how this market is done, but there are a few.
Yeah, a lot of them are in like, well, I think it comes back to like kind of company management, and a lot of them are actually in the retail space. And you know, like you mentioned Intel, right? But you've seen like Estee Lauder, Nike has it. Mike, they've had a lot of CEO, a lot of them have had CEO changes recently. So we'll see if they end up being like a turnaround story. I think it's another aspect of this kind of stock pickers market. You've seen a lot of activists come in and demand things of companies that aren't doing well, and the CEO ends up changing. We saw Starbucks, right? Like that to me remains a name that can it be turned around by the new CEO? And if it can, then it should, that it probably is attractive, right? Like but it ends up being based on the decisions of a human and his team or her team. And so that's why I think it's these are really good ones I think to watch. I always like bottom fishing, but I'm not I think one thing to caution is like I kind of like bottom fishing, but I like watching momentum and decisions and watching the earnings, and I usually tend to wait a little bit. And maybe you miss the turnaround if it comes. But I that's just sort of like my personal approach. But there's definitely a lot of names to look at that have seen a change in company management, and if that turnaround story can come for the company.
Perfect. And I know we might be a little bit over time. Apologies, Steph.
Sorry.
I just really enjoyed the conversation. This has been great. I wanted to see, Amit, if you had any final comments or thoughts here.
No real final comments. I guess one last quick question for you, Stephanie, is how convinced are you on the AI revolution over the next decade? I know it's kind of a loaded question, but are you convinced that AI is a thematic that will last for the next 5 to 10 years?
Yeah, absolutely. I think it will be something that will change the way we work and live. Uh, but I think like any new secular shift in the market or economy, you will see time periods where there'll be consolidation from it, meaning that like the expectations get beyond what it can do in the short term, and then the technology catches up. So I would say, this is a very old example, and I'm sure everybody uses it when they compare the two. I actually see them a little bit differently. But when the internet first became a thing, obviously the stock market took off in the late 90s. And actually, that's the last time we had a soft landing. Um, and, the crash didn't come until, what was it, 2000 or 2001. But, that was a time where expectations probably got ahead of themselves a bit, but they weren't wrong. It just took a little longer. I think AI will be faster than this one. But we could be at a point where maybe expectations are getting a little bit ahead just in the short term. But I definitely think it's going to change the way we live and work for sure.
Beautiful. Great questions, both. Thank you so much to Steph for leading this conversation with us and giving us so many great insights. To the amazing audience, there's over 600 live listening in,
Oh,
of course.
wow. Thanks for
Yeah,
joining
Oh,
yeah.
me.
hold on. We have
Well,
1,500 live on my YouTube stream that are listening as well. So we got over 2,000 people listening to
Oh,
Stephanie.
my goodness.
People definitely appreciate your thoughts, and we're just happy you're engaging with the retail community. So thank you, Stephanie.
I'm very humbled. Thank you.
yeah. So thank you so much. I'll turn it over to you, Steph. Any final thoughts that you'd like to share out to retail investors, and maybe what they can expect to see from Robinhood engaging with retail over the course of 2025?
Yeah, we've got a lot of, we launched some great products this past year. Robinhood Legend, index options, and we've got, more coming. We've certainly had a bunch of announcements, expanding internationally. But we have way more on the way for next year. It's going to be a packed schedule. So just stay tuned. I'm really, really excited for some of the new stuff we're gonna be able to bring to our customer base. If that wasn't too cheesy.
No, we can't wait. And there's going to be these furtherhood summits and
Yes.
events. There's a lot of opportunities for retail to continue to learn and engage and participate. So thank you again so much for doing this with us. This is recorded. So right after this closes, people, you can go back to the start, listen to the recording, right here on X. We look forward to the next one. Thank you, Steph. Have a great one.
Thank you.
All right. Not bad. Not bad at all. Dude, you guys are the funniest chat in the history of chats. I don't care what anyone says. Like, those 30 minutes flew by primarily because of these comments in the chat. It was too good. Yeah, I don't flex numbers like that, dude. I usually don't flex numbers, but like, I wanted her to feel good that there's actually people listening to her. I mean, the fact that you guys are here and you care about listening to what she has to say, or more so listening to me try to come up with a question to get her thoughts. Regardless, you know, people are listening to her, so hopefully it's cool, and hopefully maybe that starts the potential of her coming on the show more. You know, it would definitely be awesome to have the Liz Youngs, the Stephanie Gills of the world, all those people hop on our show as well. That was fun. That was really fun. So overall, her thoughts: 6,500 target on the S&P 500. Nothing too different from the other analysts. She thinks a rotation of small caps makes sense, and pretty much in line with a lot of other of the consensus opinions on rotation from large cap to small cap, and hopefully 10 to 12% gains on the S&P 500 next year as well. Now, having said that, while we were having this conversation, Bitcoin cannot hold its weight back to 92,000. It was at 94 at 350. You would think it could hold. It did not hold. And MSTR is well below 300, folks. We're at 295 on MicroStrategy. That's not good. That's not good. Robinhood's getting hit as well, I think. Hood's down another 1.49% after hours. Coinbase down 1.3. I don't know what happened at the bell. But at 357, you saw MSTR go from 315 to 301. So already we saw the weakness. And then I guess someone knew that Bitcoin was about to tank. It's almost like someone knew at 357 Bitcoin was going to tank after the bell. They either shorted MicroStrategy or sold MicroStrategy. And then coincidentally, 15 minutes ago, MicroStrategy tanks 3% because Bitcoin's down 0.5%. I don't know. But you do have some of the crypto volatility that's still creeping up right now. SoFi's down a little bit after hours. The indices are also down a little bit. S&P and the Qs, nothing too crazy. Hollow, that was up 170% today. It's down 7% after hours. Faraday Future is up 8% after hours after being up 78% for the day. Palantir's down another 0.5% after hours. Tesla's down another 0.5%. Archer's down another 0.5%. And then Coinbase right here down 1.39% currently right now. So we've got some volatility that is not stopping towards the end of the day. It is not stopping at all. Damn, bro. You would think that we had a we did have a reversal today. Like we did, but like now after hours, at least in the crypto sector, it's not a reversal. This is just like more of a bloodbath. We're just seeing more and more go down. Shout out to Evan, by the way. If you're not following Evan on Twitter, let me put Evan's Twitter right here in the chat. Evan, we got to get you more on YouTube more. You got to call into the show and just give us your thoughts on stuff. But this is Evan on Twitter. You guys probably know him. If you're on Twitter, stock market news, this is like a must-follow account for news updates in terms of what's going on. Yeah, I agree with I'm beneficial as well. This is nothing. This isn't something to be scared about or anything like that. I think I haven't listened to Meet Kevin's content yet, but you guys are telling me he's getting super bearish. I'll try to listen tonight and try to see if he has any perspective that's like, because I always want to listen to the Bears. I have to listen to the Bears. You can't be a good bull if you don't listen to the Bears. So you definitely have to listen to them. I'm going to see if he's putting together a meaningful thesis or if it's just kind of in the moment trying to find a way to be bearish. But look, it's red before the end of the year. The S&P 500 still, it's important to, I hate saying zoom out, but it's important to zoom out. S&P 500 still up about 24% this year. That's an incredible year. An incredible year. Now, again, we looked at a chart this morning. Real equity returns from 1900 to 2023 are 6.7% on the S&P 500. That's adjusted for inflation, and that's adjusted for dividends being reinvested. So to go up more than 4x the actual real return of the S&P 500 over the past 120 years, that's not a bad year. It's a pretty damn good year, even if the last 2 days of the year are not as green as we want it, as we want to see. It would be nice though if it was green though. It would be really nice if we ended the year green. Like it would have been so much fun to just end green. But I mean, we got 1 day left. There's a shot. My price target, I think a lot of people are gonna be wrong. Remember I had that challenge in the chat of like put in your price target for the end of the year and screenshot it and send it to me if you're right. I had 601.27. 601.27. So where are we at right now on the S&P? We're at 588. Let's do some quick maths. Okay. S&P, goodness, Bitcoin, bro. S&P's at 588. So to get to 601.27 minus 588.07 divided by 588.07. We need to go up 2.24%. Need to go up at least 2.5% for me to be right on that prediction. And if not, so that means tomorrow we got to have a great day, because to go up 2.5% in one day is not easy. John said I had 615. Yeah, I don't know if you're getting 615, bro. That's 599.84. It might not be crazy. That's like 1.3%. I'm above 6,000. So now we got to see. We got to see how we end out this day. Yes, tomorrow's a full day. Tomorrow's not a half day. Tomorrow's not a half day. We got a full day. So we got lots of markets to analyze tomorrow. And we're going to try to see if we can end out hopefully green. All right, let's hear from Dan Niles. He was on CNBC just a couple of minutes ago. Let's get his thoughts on where this market is going. And then we'll keep going from there.
But finishing well off the lows. Chips were some of the worst performers, although NVIDIA was a notable outperformer. Joining us now is Dan Niles, founder and portfolio manager of Niles Investment Management. Dan, good to see you. So you think AI spending is going to see a bit of a slowdown in 2025? How does that affect some of the biggest names? How does that affect the overall indices?
Well, I mean, I think if you look over the last couple of years, really since ChatGPT was introduced at the end of 2022, AI has been the theme, obviously, that's driven the entire market and driven NVIDIA to be the most valuable company in the world at one point. So I think if you do have a spending slowdown in AI CapEx next year, it's going to be a big problem for the Magnificent Seven, because for those investors with a little bit longer memory, they remember that during COVID, you had this huge surge in spending. NVIDIA's revenues were up over 80% year over year in 2021 at the beginning of the year. And then by the end of 2022, as their big customers, Microsoft, Amazon, et cetera, went through digestion of that COVID spend, the revenues went from up over 80% year over year to down over 20% year over year. So as you're thinking about next year, when you've got big customers like Microsoft, and the CEO of Microsoft was asked in the middle of December, hey, do you still have a chip shortage? He said, no, I don't have a chip shortage. I have a power shortage, but not a chip shortage. And that's a very different statement than what NVIDIA has been saying, which is we're going to be seeing more demand than supply for the next several quarters in 2025. So something's got to give. So we'll see what happens, but I think that's pretty negative for AI companies next year.
So can you have that kind of a slowdown affecting the largest stocks in the market without it having a valuation impact on the entire market?
No, you can't.
Yeah, there's no way. There's no way. This is not rocket science. If the large caps take a hit, the market takes a hit. Unless somehow all of that money that leaves the large caps immediately go to small caps. But if the market takes a hit, I just don't know how many people are running to IWM for safety.
Because obviously the biggest stocks have the highest valuation. So if you look at the Magnificent Seven, with the exception of Meta, they're all trading at a low 30 PE. The S&P 500 is trading at a 25 PE. But if you look at the mid cap and small cap stocks, which people have forgotten about because they're not really AI plays, they're trading at around 19 to 20 times. And they've underperformed up until sort of mid-year when the performance has picked up. Because if you look at stocks since June 30th, basically, the S&P is up about 8%, but the NASDAQ 100 is only up 7. The Russell 2000 is actually up 10 after being only up 1% for the first 6 months of the year. So you're already starting to see this broadening out. And I think with the new administration really focused on domestic manufacturing, deregulation, et cetera, that's going to benefit the small to mid cap names more so than names in the S&P 500, which also have to deal with other things like the dollar going from 101 to 108 since the end of the third quarter. And when you've got 30% of your revenues that are international, that's an immediate hit to your top line when all these companies start to guide for Q1 and for the rest of 2025 in some cases.
He's right about that, dude. So the dollar has to come down. I actually don't know what's going to make the dollar come down. So I'm going to ChatGPT how the US dollar could come down while we listen to him. And then after we listen to him, we'll see what ChatGPT says. Because He's right. That dollar has to come down. It's got to get to at least 102. If it stays at 108, it's not going to help anyone right now.
Yeah, so Dan, I hear you talking about small and mid cap and maybe steering clear of Magnificent Seven then for 2025. It sounds like the Fed.
Yo, Morgan's sick as well. You guys can hear it in her voice, right? Morgan's sick. On the morning show, the CNBC hosts were sick. You can tell Morgan's sick. Everyone's getting sick right now.
You've been talking about this all year. Don't fight the Fed. What does don't fight the Fed mean in 2025, especially given the massive repricing that we've seen in the markets in anticipation of a Fed becoming perhaps more hawkish and cutting fewer times last year, especially given the fact that I don't think the Fed even knows where the Fed is going in 2025, at least not yet.
You're 100% right, Morgan. I mean, if I were to tell you, hey, inflation's going to go from 1.4% to 7% over 12 months, you're going to be like, oh my God, the market's going to get killed. Well, that's what happened in 2021, and the market was up 27%. So it's one of those things that the market doesn't care right up until it cares. And I think it started to care when Jerome Powell on December 18th, during that press conference, came out and said, you know, the Fed inflation forecast had, quote, kind of fallen apart. And when he said that, the market was like, oh my God, the fact that, by the way, all measures of inflation had bottomed out in the third quarter and had been going up for several months. Nobody cared, right? The market kept going up. But as soon as he said that, much like in 2022, when you saw the market go down 19% as the Fed finally admitted inflation wasn't transitory, I think that might have been the wake-up call, which is why I think Q1 could be a really rough time for a lot of the, you know, the market as a whole, but a lot of the mega cap stocks as well.
Bro, CNBC is going bearish. This is like the fifth analyst today that I've heard say Q1's going to be bad for the market, particularly for the Mag 7. Either consensus will be correct or it's going to go the opposite. But right now, the mainstream analyst assumption for the next 5 months is bearish large cap. Like that's just objectively, that's how these analysts are thinking about it. And so now the question is if that actually plays out.
As we have to kind of price in the fact that the Fed might, you know, they might pause or they might even raise next year, which I think that's a 50-50 shot of whether they cut or raise or hold.
So you think the reigniting of inflation is a very real risk here? What does that mean not only for stocks, but for other things like the dollar, which you just mentioned, and the bond market and other asset classes?
Yeah, and that's really what I'm looking at, because I've written about this for, I don't know, several months at least, that the thing I'm watching the most is 10-year Treasury yields. And the Fed now has cut about 100 basis points. 10-year Treasury yields during the same time have gone up about 90 basis points. And if you say, okay, CPI is at 2.7%, what has the market multiple been in the past when CPI has been 2.7%? The S&P multiple has been 19 times. Right now, it's sitting at 25 times. So you don't have a lot of valuation support. The other thing is 10-year Treasury yields have typically been over 100 basis points higher when CPI has been at this level. So you could argue, hey, there's potentially you could lose money in both bonds and stocks next year. I mean, obviously, this is a very light last week of the year. This is going to get a lot more interesting when everybody's back from vacation in early January, and you combine that with, hey, we've got these massive gains that we wanted to postpone until this year, when we might get maybe lower taxes with Trump back in office. Who knows? That you could have a big sell-off at that point to start the year as those gains get postponed.
So, stock, sector, asset, what are you most excited about for 25 then?
Cash.
Wow. Cash. Hell of a call right before the new year. Cash is what he's most excited about.
I think investors should think about going into next year with a fair bit of cash on the balance sheet because of some of these things. And we haven't gotten into things like there's no election. Well, there was a huge amount of spending in the fourth quarter. That goes away in Q1. So that makes it kind of tough for Meta and Google. Easter shifts out of March from March 30th of this past year to April 20th, or March 31st to April 20th this year. So that makes it tough for an e-commerce name like Amazon. So I think cash is a pretty good thing. I'm looking at small, mid-cap ETFs. Those are good places to be if you feel like you have to be invested. for some reason. But I'd be very cautious of the momentum names that got us here, because that might be where some of your risk is if people want to rebalance to some of these other non-sexy, non-AI places like smaller mid-cap stocks.
Okay, some action.
All right, so let's break down what we just heard from there. We'll talk about the dollar, and then we'll be done for today. I don't disagree that having a decent amount of cash in 2025 is a good strategy. Obviously, because I'm a dip buyer, and if we get some juicy dips, I would love to be continuously investing in those companies. The question is, here's the big question: do you raise cash right now before 2025 or going into January? And if you do raise cash, which I don't think is the worst idea, but if you do raise it, what are you selling to raise it? And I think this is where obviously, you kind of have to take a look at your portfolio and do a check on it. But like, if you have Google at an average of 120, do you sell Google at 190 to then buy Google again if it dips to 140? I don't think that really makes a lot of sense. But like, I think that's kind of the narrative that these people are going with in terms of raising cash. So, I mean, if you have a name that you don't want to be part of that story anymore, or better yet, it's a loser. Like my sister had a couple of losers in her portfolio today. I manage her portfolio from 2021. And like, she has not let me sell those names because like, she thinks it'll just come back. And I had a conversation. I was like, you got to let me sell this stuff. You got to let me clear it up. Man. Like I need to manage a real portfolio, not have this junk from 2 years ago that you think is going to go up 1,000x and get you to break even or something. So she finally agreed. And so we tax loss harvested a decent amount of losses today. And now she's not going to have to pay any taxes on capital gains because we took some L's, which is not too bad, right? And we actually raised a little bit of cash going into next year. But the question's going to be, what do you sell to raise that cash if you do want to have that cash? And if you don't want to sell anything, then, I think basically he's saying try to have as much disposable income as you can to get back into the markets. So I don't think he's wrong with that idea of having cash on the sidelines. Now, to say he's the most excited for cash in 2025, I think is a weird way to frame it, because I am not excited for cash in 2025. I'm much more excited to invest that cash. But I think having cash to be able to invest it is the most important thing if we do get this huge 15-20% dip that everyone's talking about. Now, the second thing from that segment is, again, I'm getting a little worried that every single analyst is beating the same drum, which is correction, Q1, volatility, large caps, go to small caps. Like that's the playbook that we've heard from someone like Dan Niles. We even heard it from Stephanie, who was just on the Twitter Spaces, right? Basically her saying that, hey, I think small caps are more attractive right here, and large caps you should be trimming. This is let's do a poll. Let's do a poll on this one. This is going to be one of those market calls that either a month from now, if the market's up 3-4%, all these analysts are going to have to eat their words and basically get bullish again, because there's no way they can stay bearish if they're not actually bearish on the markets. They're just trying to call this eventual correction, or they're going to have to double down. And I don't know. I don't know if it'll be that easy to double down. So the question right here is, Mag 7, 10% pullback in Q1, yes or no? Because basically this is what they're arguing for. They're arguing for Google to go back down to 170, Meta to go back down to 500 or at least 530, Apple to get back down to 230. That would be your 10% correction. It's 56% no in the chat, 44% yes, or 42% yes, 58% no. I don't know, bro. I don't know if it's that. Like, I was more on the side of, yeah, we'll get a little bit of a correction in Q1. But now that every single analyst, if you go to CNBC's videos, just like pick any of them, and they got a couple more shows today, listen to any of the videos from those shows. The narrative is going to be sell or trim your large cap tech and get ready to diversify into small caps and mid caps. And I don't know. I don't know if that's going to happen. And I'm a little skeptical that people want to go to IWM over Amazon. But then again, if Amazon gets ridiculously overvalued, which I don't think it is at this point, then do people, leave at that point into a different sector? Now, one thing he did say that was an eye-opening stat was that the average S&P 500 price to earnings is 19 when CPI is at 2.7% historically. CPI currently is at 2.7%, and the S&P 500 average PE is 25. That stat, I think, is a little misconstrued for a couple of reasons. Number one, we were at 2.4% in September. We magically got up to 2.7% because of whatever other external factors, primarily shelter and automotive inflation, that boosted CPI higher. If that's 2.7 goes back down to 2.5, you can't say that a 25 PE trailing on the S&P 500 is insane. Now, objectively, that is much higher than what it has been historically. But if you're using CPI as the barometer to then make a comparison on where the market should be trading, well, if CPI is elevated right now, but it's going to be coming down pretty soon, and maybe it doesn't come down, right? So that's the risk. But if it does come down pretty soon, I don't think that stat is necessarily correct. The other reason I don't think that stat is correct, and this just comes down to, do you believe in AI or technology in regards to the revolution that we're in right now, which is like, do you believe the dot-com bubble is something that could happen to the AI names? And if you think that can't happen, or that the likelihood of that happening is not right, then we will naturally have an S&P 500 that will be more expensive. We will naturally have a NASDAQ that will be more expensive. We will naturally have value. $1 trillion won't be special. Like there's like, I think $8 trillion companies right now, or $9 trillion, if TSMC and Broadcom, so $9 trillion companies. Is Berkshire at $1 trillion? That'll be the 10th one. I think Berkshire is there. But in 10 years, $1 trillion might not be that crazy. It really might not. So if that's the case, I don't think we can use the historical pricing of S&P 500 trailing 12-month PE ratios. Because if you looked at it in 2008, a 19 PE would be insane. It would be a 10 PE. And now we're like, well, a 19 PE is better than a 25 PE. But what if in 10 years, a 25 PE is way better than a 35 PE? So again, I think there's a lot of things to digest, a lot of things to kind of put together to create a narrative. But right now, at least getting into the beginning of Q1 for January, the objective thing we know is the mainstream media is on the side of a correction in large caps. That is definitively true. And I think there's a lot of other parts to figuring out how we navigate Q1, but that's the first pillar that has basically been confirmed to me today. I still think we have no idea what's going to happen to the 10-year. We really don't know what's going to happen with CPI. January 15th, we get results. We have no idea what's going to happen with Jay Powell and Trump's relationship. We have no idea what Trump's going to try to get past in the first 100 days. A lot of unknowns, but the one thing we do know that is confirmed to me right now, mainstream media is on the side of a 10% correction in the Max 7. And maybe they'll be right. And if they are right, I think having cash is good to buy that dip. But if everyone is saying it's going to happen, I don't know, bro. Like, I don't know if it's that easy to just imagine that tech takes that big of a hit. Now, there are some names like Apple. Like Apple, I don't think deserves to be $4 trillion right now. So I could see Apple taking a correction. But the problem is, oh my God, Bitcoin 91,000. Goodness gracious, dude. MicroStrategy still down after ours 295. The problem is if Apple falls, like, does Google deserve to be worth 2.3 trillion? Yes, in my opinion. Does Apple deserve to be worth 3.8? No. But if Apple falls, Google probably falls with it. And I think that's part of the call that these analysts are making on large cap tech. It's going to be very hard for one of them to outperform the others. Even Tesla, like Tesla theoretically shouldn't be pegged to Apple, Nvidia, Microsoft, et cetera. But we know how the algos are going to treat Tesla if Apple, Nvidia, and Microsoft take a 10% hit. Like Tesla's probably taking a 10% hit as well. So at this point, if you own one of the Max 7s, to be honest, you own all the Max 7s because your entire ability to see that Max 7 get price appreciation, even if it goes up or down at a different delta compared to the other Max 7s, it will move in unison most likely with the other 6 companies. And ultimately, 2025 will determine kind of how this plays out. Lulu is late. Thank you for the $5 super chat. How many of you guys have bought Palantir at these prices? We need it to go down so we are comfortable buying again. Yeah, I think most people are not, from the people I talk to, are not buying Palantir here, which is why I'm also saying it's kind of a win-win for Palantir investors. If Palantir keeps going up and you've been in it for a long time, great. You have more gains. If it goes down, you get to buy the dip. And this is one of those things where the mainstream media, the bears, are going to be like, oh my God, Palantir's down. It's like, okay, shut up. You missed the whole run. You never understood Palantir. You're definitely not going to understand Palantir as it continues to come down. Longs that actually believe in it will take advantage of it. And the same thing that I'm describing right here happened to this bad boy, which is Tesla. And I was on the opposite end of this story. When Tesla went to 100, I didn't understand it. And I thought it was dead. Not literally, but you know what I mean, right? Like you just didn't want to touch the stock. You were scared. And when in reality, that was the time, if you were a Tesla long, to go as long as you could, right? There's this guy named Jason DeBolt. You guys know this guy, right? On Twitter. This guy, I don't think anyone should do this, but he had a different situation. In 2017, he sold his house. He was living in his car. He went on margin. He did whatever the hell he could do to get more Tesla shares. And now I think he's sitting on like $20 million worth of Tesla. So I'm not saying you have to do that with Palantir or anything, but the point is to make a metaphor that like when things go down and you know what you hold, you should get excited to buy those things. So although I don't think people are buying Palantir right now, I think they will be excited if we get a dip. But the question becomes, if everyone's waiting for the dip, do we get the dip? And it's the same thing for the Max 7. If all these analysts are waiting for the Mag 7 to take a 10% correction. Do we actually get that 10% correction? I think that's the question that we are going to be having to look at going into next year. Okay, US dollar. Let's talk about the US dollar. So I asked ChatGPT, what will it take for the US dollar to come down? Here's what ChatGPT said, when the US dollar is considered too hot, meaning it is excessively strong, overvalued, or the economy is overheating, several mechanisms can lead to depreciation. Number one is monetary policy. The Federal Reserve may adjust interest rates to cool down an overheating economy. Higher rates tend to attract foreign investments, strengthening the dollar. Conversely, lowering interest rates can make the dollar less attractive to investors. Okay, so that's an issue because we've lowered rates, but the dollar has not come down, similar to the 10-year. So I actually think, if you just put them side by side, maybe the dollar will come down if the 10-year starts to come down, but the 10-year is not going to come down until inflation comes down. So that might be the conundrum for the US dollar right now. Also, quantitative tightening, reducing the money supply by selling government securities or allowing them to mature without, okay, so QT, which the Fed's not doing that much of anymore. Inflation control, rising inflation. If the economy is overheating, inflation may rise. To combat high inflation, the Fed might implement tighter monetary policies, which is what they did in 2022. Purchasing power, higher inflation erodes the purchasing power of the US dollar domestically and internationally, making it less attractive and leading to a weaker exchange rate. Okay, so that ultimately comes back down to rates have to come down. Trade deficit. An overheating economy may lead to increased imports as consumer spending rises, widening the trade deficit. We probably saw a little bit of that in Q4 with the holiday season. A larger trade deficit means the USD are being sold to purchase foreign goods, which can reduce the USD's value. Interesting. So if our trade deficit increases, that's actually bearish for the US dollar, which is technically bullish for us right now because the US dollar is too hot. Export competitiveness. If the USD is too strong, US exports can become more expensive for foreign buyers, potentially reducing demand for US goods and services and exerting downward pressure on the currency. So that's basically like China saying, hey, we're not going to buy, what does China buy the most from the United States? Is it rice? It's one of those things they buy from the farmers, or soybeans. I think soybeans is what they buy the most from the United States. China basically can say, we're not buying any of these soybeans until your dollar comes down because we're paying too much for the soybeans. Now, is China in a position to negotiate like that? Not really, but nonetheless, so foreign entities have to step up and say, we're just not buying, which should reduce demand. And that reduction of demand hopefully can help the dollar slow down a little bit. Government intervention. The U.S. government or the Fed might intervene in the foreign exchange markets to influence the USD's value. This could involve selling USD reserves to increase supply and lower its value. I don't think that's going to happen. And then global economic factors. If other major economies strengthen their currencies or implement policies that make their currencies more attractive, the USD may weaken. So this is a catch-22 because if Japan raised rates, that would weaken the dollar. But the problem is that would unwind another yen carry trade and then hurt equities. So it's not like that easy that other countries can just raise interest rates and strengthen their currencies, because that's definitely not good for the USD long term. And then finally, reduced demand for USD denominated assets could lead to depreciation as well, like treasury bonds. Right now, that's not happening. Everyone's selling off their damn treasury bonds, and that's why this yield continues to be high, which means the dollar continues to be a little high as well. All right, that's what we got. Pork. It's pork, right? Yeah, pork and soybeans. Those are the two things that China buys the most from the United States. Pork and soy, and GPUs if the US will let China buy more GPUs. But so many variables making my head spin. Yeah, because you think, okay, so this is the solution to the problem. But then you realize if that happens, then this happens. And this is why analyzing the markets are so fun, because you just never know how this is going to play out. Granted, one thing I do want to say before we end off the show today, so we're done with the market close here. Thank you, everybody, for joining. Thank you, everybody, for listening to Stephanie Guild on that Spaces. That was awesome, and hopefully we get her on the show more often. The unpredictability that everyone's feeling right now in terms of, is a Santa Claus rally going to happen? What's January going to look like? Yada, yada. That's kind of that's what we have to deal with as investors, right? I was thinking about this today. It's like, I'm a little worried in terms of going into January. What are things going to look like? I'm a little confused. I'm more than a little confused. I'm very confused on all these different variables that are affecting the markets. But like, that's kind of the point. If it was so easy to know exactly what to do, no one would make money. It was not easy when Robinhood was $8 to make a bet. It was not easy when Palantir was $7 to make a bet. It's like, it was not easy when Tesla was at 138 in April to make a bet that Tesla's going to be. So it's like, we kind of do need a little bit of confusion here. Everything shouldn't be very simple to understand. And hopefully as a community, Bitcoin back above 92,000, we can try to dissect all of this over the next few years, and definitely over the next few months as we get into Q1. But like, part of the confusion is part of investing. And we got a lot of variables, got to break down a lot of variables. Ultimately, I think those variables conclude in a bullish case for 2025. But every single day, we're going to have new news that we have to analyze to try to figure this out. This stream was 1% about the market and 99% about Stephanie. Yes, exactly. That was the case. She's cool, though. She's awesome. She's super cool. And it's awesome that she's like willing to talk to retail investors and just like engage and have these conversations. So not bad stuff. I'll be back tomorrow on the Market Open. We do have a video coming out in about 2 hours, probably 7 p.m. Eastern. The UBS price target by Palantir, analyzing it, $80 price target. I know we haven't had daily Palantir every single day, daily, like we did a couple months ago. Honestly, the real reason has just been traveling, end of the year, holidays, my mom's birthday, Christmas, New Year's. It's just been like so much stuff going on to try to do a video daily. Is there enough news to talk about daily? Yes, there is. There's more than enough. And to be honest, we do talk about it daily on the show, on the Market Open, Market Close. So we kind of do talk about it daily. But to actually make the video, there's just been so much going on. On top of that, when I went to India, that really messed up the schedule because it was barely possible to stream from India. So like making a video there was a bit tough. So 2025, we will get back to our daily Palantir every single day, Monday through Thursday. We don't do it on Friday because we have Palantir weekly on Friday. So we'll get back to action, and we'll start off today with a video on this UBS price target as well. We will be having TA with Jason unless anything has changed. By the way, Jason is definitely taking a victory lap right here on MicroStrategy. I was waiting for him all day to take his victory lap, and he is officially taking it right now. So yeah, well, we should have Jason on tomorrow. We'll do Technical Tuesday and get into all that good stuff. He said, where did all the MicroStrategy bulls go? And I was like, seems like Jason's taking a victory lap. He said, nope, this is the pregame warm-up. Maybe he's getting a little too bearish, bro. We got to ask him about that tomorrow. Maybe he's, I don't know, MicroStrategy under 300. Like, is it time to still be that bearish? At 500, I get it. At 400, I get it. At 350, I get it. At 295, is this thing really going to 250? I guess we'll see. And we'll get Jason's thoughts tomorrow on where he thinks this ends up playing out. Oh, Hood Weekly tonight. Yeah, I forgot. Hood Weekly tonight. So at 9:30, we'll be back for Hood Weekly. We're going to have a special guest on today as well. It'll be me, Tanner, a special guest. It'll be fun. So Hood Weekly at 9:30 p.m. tonight. And we'll be discussing more about Robinhood and what the heck they're going to do tomorrow on 12/31. NYE stream, yes, we're going to be having a New Year's Eve stream. I think Michelle said, what are your New Year plans tomorrow? It's to stream at like 7 p.m. I'm going to get some Mike's Hard. And what's another drink I should get? What's another drink? We can't open that whiskey. Maybe I'm going to get, maybe I'm going to go buy some. Dude, honestly, you know my favorite drink? You guys will make fun of me. It's such a college drink, but I love Jaeger bombs. Jaeger bombs are amazing. Like I actually can down 5 or 6 Jaeger bombs like easily. That was like my number one drink in college. Is that a lame drink? I don't think that's a lame drink. It's a decent drink. Jaeger bombs is not crazy. So maybe I'll get some Jaeger, some Red Bull, and some Mike's Hard. And we will drink and just talk tomorrow and stream. And maybe I'll see. I don't know if Chris is out free or anyone else is free, but oh yeah, that's what I'll do. I'll put the StreamYard link in the chat, and anyone who wants to join, you can just join on, and we can just kick it on New Year's Eve. Or you're not doing mayo bombs ever. Please never mention that again. What is this, 2000? Yo, Jaeger bombs are not from 2009. I was drinking them in 2019 in college. Jaeger bombs can't be that old. One of the things I'm going to learn when I move out is how to make proper drinks. I'm going to try to have a bar set up in the apartment and like legit become a barista and try to figure out how to make drinks. But as of now, I'm not the best at doing that. I know Jaeger bomb, I know Smirnoff Ice, I know Mike's Hard, and then I know Jack Daniel's Honey, and that's it. And it's so embarrassing, bro, because my dad owned a liquor store. Like I should know. We have so much liquor downstairs, bro. So much. If I wanted to get drunk every night, like I could like just go downstairs. Like but I don't know how to drink. I never drank. I just don't drink. So, and that's kind of good, right? Because drinking can get into a bunch of issues. But like when it comes to like professionally, like knowing how to drink, I'm so bad at it. I'm so bad. All right, that's it. Thank you, everybody. We'll be back tomorrow, Market Open, and then wait, tomorrow's December 31st. Oh shit! So we're doing 3 streams tomorrow. We have the Market Open, the Market Close, and then the New Year's Eve stream. Yo, the reason why it's confusing is tomorrow feels like the market should be closed because it's New Year's Eve. but it's not closed. So we'll be in the morning, in the afternoon, and then in the late night going into the end of the day. So tomorrow will be a jam-packed day, and we'll be here live the whole day. All right, that's it. Thank you, everybody. We'll be back for Hood Weekly tonight. Daily Pouncer episode in a couple hours on the UBS price target. And that's it. I'll see you guys for a long day tomorrow. All right. Bye, everyone. Love you all. Thanks for joining. I'll see you guys tomorrow. Bye-bye.